What's happening in tech, I mean, broadly at the moment? Because can we look at the companies individually, or is it just sentiment within the sector? The fact that Meta can swing out the entire sector like that, what do you make of it?
Hey, thank you very much, and I appreciate you having me on the show. Well, I think that first and overall, the volatility that we're seeing in the equity markets, and particularly in technology, high duration assets, is somewhat typical of times during monetary policy change. And I think that what makes this time of monetary policy change different than others is just what had happened during the pandemic. So the pandemic clearly flooded the market, and particularly this sector, with just a ton of retail investors. That became kind of a feeding frenzy for the algorithmic traders that were out there. And that just led to so much volatility that we've been seeing over the past year. And now with this massive shift in monetary policy change, so this removal of liquidity from the market, you're seeing just unprecedented volatility both up and down as market participants are trying to figure out what exactly to make of it. How many rate hikes are we going to see? And I think that for a lot of people out there, just everything going on in the macro is so daunting and difficult to understand that it's just creating these wild volatility swings that most of us haven't really seen before. That said, we think that within tech, it's a combination of both. You're seeing the overall volatility and heightened level of fear in the market that has just become present throughout these type of growth assets. But then in particular within the companies, now we're entering kind of a new landscape. We're rolling off of the pandemic benefit of engagement that a lot of these subscriber-based platforms have been seeing. And we're seeing right now, which platforms have the capability to withstand the changing future. So which platforms can handle things like Apple IDFA, which platforms can come off of tough comps, which platforms have other growth engines besides just pure user engagement that clearly saw a temporary tailwind from people staying at home. So it's a really interesting combination of kind of a volatile macro backdrop combined with a bifurcation in companies' performance that people aren't really used to seeing from the quote unquote FANG stocks that usually are more or less a rising tide lifts or sinks all boats.
You've summed that up, I think, just so well in terms of bringing in all the themes, the macroeconomic, not forgetting that salient point about retail investors flooding the market last year. And what is the path forward for some of these social media companies? So let's split some of those out and just talk about, if you're in the market at the moment, is there a buy the dip mentality still with some of these companies? Is there some value to be had?
Well, I think absolutely there is and should be a buy the dip mentality in some of these companies. I mean, if you look back over the past, even 3 to 6 months, what we've seen is not just normal volatility. We've seen extreme volatility, really good assets that have seen their stock prices fall 50 to 70%, even 80% in certain cases, from a time period since something like last October or November. And, that's just really not normal, for companies that are not speculative companies or companies that have real valuations and real business models, and some of that occurred even before they've even reported earnings. So I think that when you go through the rubble here, there are tremendous buying opportunities and so much value to be had in this space, particularly social media and others throughout tech, where either babies got thrown out with the bathwater or overall the whole space just got crushed on sentiment. So we think that right now what we're actually seeing is a hesitant buy the dip mentality. So as we saw kind of towards the end of last week, when stocks really bottomed out, became oversold, and some of these moves were just kind of extreme and fear and panic hit an all-time high last Monday, stocks then kind of found a bottom and later in the week and earlier this week rebounded. But then again, what you saw was when Meta missed, everything then reversed and you saw, you had kind of 2 days of somewhat of a retest the lows type mentality. And now today, as you mentioned, it's a bit of a roller coaster ride and you'll see a whipsaw higher. So I think that that's indicative of people wanting to buy the dip, but still just kind of being afraid of any negative data point that comes out and trying to understand this kind of new world that we're in. And I think that this volatility is going to probably persist until market participants get clarity on exactly what the Fed rate hike trajectory is going to be and the magnitude of that March rate hike. And in overall likelihood, I mean, the market is pretty much pricing in, at least 5 hikes right now, over a 30% chance of a 50 basis point hike towards the end of March. So likely whatever happens with this Fed situation is already priced in the market anyway. So I think that for investors who are willing to look past, a couple of weeks of up and down volatility,
right,
buying into these dips makes a lot of sense.